If you are 65 or older, the IRS is currently sitting on a tax break worth up to $6,000 that most retirees have never even heard of, and the deadline to use it is closer than you think. Every year I go through the tax code line by line, looking for the rules that actually apply to people over 65, not the generic advice you hear everywhere else. And quick heads up, this is general information, not personal tax advice. So now let's get into rule number 1, because this one alone could be worth over $1,000 back in your pocket. Here's the situation most retirees are living in right now without realizing it. You worked for decades, you paid into Social Security, you built a 401k or an IRA, you did everything right, and then tax season arrives and you file the exact same way you always have, because nobody at the IRS calls you up and says, "Hey, by the way, there are 7 new or underused breaks specifically for people your age." Your tax software doesn't flag them either, because most of it just runs the numbers you type in. It doesn't ask, "Are you sure you're not leaving $6,000 on the table?" It just calculates. And the accountant down the street, if you even have one, is often juggling 40 other clients during filing season and doesn't have time to walk you through every new provision that changed this year. So the breaks sit there, unclaimed, year after year, while retirees who are counting every dollar of their fixed income keep paying more than the law actually requires. This isn't a conspiracy. Nobody is hiding this from you on purpose. It's just that the tax code is enormous. It changed significantly in 2025, and almost none of it gets explained in plain English to the people it affects most. So today, I'm walking you through 7 specific things retirees need to know for the 2026 tax year, in plain language, with real numbers. Here's where this comes from, so you know I'm not making any of this up. On July 4, 2025, Congress passed a large tax package that's often referred to as the One Big Beautiful Bill Act. It created a brand new deduction specifically for people 65 and older, on top of everything that already existed. Separately, the IRS updates dozens of numbers every year for inflation, things like the standard deduction and the required minimum distribution age from the Secure 2.0 Act of 2022. And those updates for 2026 just came out. I've pulled the actual figures from IRS Revenue Procedure 2025-32, the Social Security Administration, and the Centers for Medicare and Medicaid Services. So everything you're about to hear is tied to an actual government source, not a guess. Let's start with the biggest one. Number 1, the new $6,000 senior bonus deduction. This is brand new, and it's the single most overlooked tax change for retirees this year. Starting with the 2025 tax year, the one you're filing in early 2026, if you're 65 or older, you can claim an extra deduction of up to $6,000, and if you're married and both spouses are 65 or older, that's $12,000 combined. Here's the part that surprises people. This deduction works whether you take the standard deduction or you itemize. It doesn't replace anything you already had. It stacks directly on top. Now there is an income limit. It starts phasing out once your modified adjusted gross income passes $75,000 if you're single, or $150,000 if you're married filing jointly, and it disappears completely at $175,000 for singles or $250,000 for joint filers. So picture a single retiree named Linda, age 68, with a modified adjusted gross income of $60,000 from a pension and Social Security. She qualifies for the full $6,000 deduction, no phase out at all. At a typical 12 to 22% tax bracket, that $6,000 deduction alone can shave several hundred to well over $1,000 off her tax bill. What most retirees do wrong here is nothing. They simply don't know it exists because it's genuinely new for this filing season, and it's only around through 2028 unless Congress extends it. If you're 65 or older and you haven't heard your tax preparer mention this by name, ask them directly. Now here's where it gets important, because this next one is easy to confuse with the one I just told you about, and they are not the same thing. Number 2, the regular extra standard deduction for people 65 and older, which has existed for years and just went up again. This is separate from the new $6,000 bonus, and it only applies if you take the standard deduction rather than itemizing. For the 2025 tax year, single filers or heads of household who are 65 or older get an additional $2,000 added to their standard deduction. For 2026, that number rises slightly to $2,050. If you're married and both of you are 65 or older, each of you gets an extra $1,600 for 2025, rising to $1,650 each for 2026, which adds up to an extra $3,200 to $3,300 for the couple. And if you're 65 and also legally blind, that additional amount doubles. Here's a concrete example. A married couple, both age 70, filing jointly for 2025, starts with the standard base deduction of $29,200. Add the extra $3,200 for both being 65 or older, and now add the new $6,000 bonus deduction twice, since both qualify, for another $12,000. That's a combined standard deduction north of $44,000 before they've claimed a single itemized expense. Most people stop here and just accept whatever number their software spits out. But don't. Confirm your software is applying both the age-based add-on and the new bonus deduction separately, because some early filing software in year one of a new law has been known to miss one or the other. Number 3, and this one has actually gotten a little more forgiving in recent years, but almost nobody has updated what they know about it. The required minimum distribution age. If you have a traditional IRA or an old 401k, the government requires you to start withdrawing money and paying tax on it once you hit a certain age. For years, that age was 70 and a half. Then it moved to 72, and under the Secure 2.0 Act, it moved again. If you were born between 1951 and 1959, your required minimum distribution age is 73. If you were born in 1960 or later, your required minimum distribution age doesn't kick in until 75, though that particular change isn't fully in effect until 2033. Here's the dollar impact if you get this wrong. Missing your required minimum distribution deadline used to trigger a 50% penalty on the amount you should have withdrawn. Secure 2.0 reduced that penalty to 25%, and it can drop to just 10% if you correct the mistake within 2 years. But 25% of a missed distribution is still a painful, completely avoidable hit. Let's say you turn 73 this year, and your IRA balance was $400,000 at the end of last year. Depending on your life expectancy factor, your required withdrawal could be somewhere around $15,000 to $16,000 for the year. Miss it entirely, and you could owe a penalty of $3,750 to $4,000 on top of the tax you'd have owed anyway. What most retirees get wrong is assuming the age is still 70 and a half, because that was the rule for decades, and it's what a lot of older financial articles still say. If you're not sure which birth year rule applies to you, this is worth a 5-minute phone call to your IRA custodian before the year ends. Here's the part they never tell you, and it connects directly to the next 2 items, because there's a way to satisfy that required withdrawal without paying tax on it at all. Number 4. The qualified charitable distribution, sometimes called a QCD or a charitable IRA rollover. If you're 70 and a half or older, you're actually allowed to start using this strategy years before your required minimum distributions even begin. Here's how it works. You have your IRA custodian send money directly from your IRA to a qualified 501c3 charity, and that amount is completely excluded from your taxable income. It's not a deduction you have to itemize for. It simply never counts as income in the first place. For the 2026 tax year, you can direct up to $111,000 this way, and if you're married, your spouse can do the same from their own IRA for up to $222,000 combined. And if it's a year you're required to take a distribution, the qualified charitable distribution counts towards satisfying that requirement. Here's a real example. Say you're 75, single, and your required minimum distribution this year is $20,000, but you don't actually need that money to live on, and you're already planning to give $10,000 to your church or a favorite charity this year anyway. Instead of taking the full $20,000 as taxable income and then writing a separate check to the charity, you direct that $10,000 straight from your IRA to the charity as a qualified charitable distribution. Only the remaining $10,000 counts as taxable income to you. What most retirees do wrong is write the charity a personal check from their regular bank account instead of having the money transferred directly from the IRA. If the money touches your hands first, or even your personal checking account, it no longer qualifies. It has to go custodian to charity directly. Now here's where this really pays off, Because reducing your taxable income this way doesn't just lower your tax bill, it can protect you from a completely different cost that catches retirees off guard almost every single year. Number 5, the Medicare IRMAA cliff. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's an extra surcharge tacked onto your Medicare Part B and Part D premiums if your income crosses certain thresholds. Here's what makes this one sneaky. Medicare looks at your tax return from 2 years earlier to decide this year's premium. So your 2026 Medicare premium is based on your 2024 tax return. For 2026, if you're single and your modified adjusted gross income from 2024 was above roughly $109,000, your Part B premium jumps by about $81 a month, or roughly $974 for the year per person, and it climbs even higher at each subsequent income tier. For married couples filing jointly, that first threshold roughly doubles to around $218,000. Here's the part that catches good, careful retirees completely by surprise. These are hard cliffs, not gradual phase-ins. If your income is $1 over the threshold, you can owe the full extra surcharge for the entire year, not just on the amount over the line. A retiree who sells a rental property, takes a large one-time required minimum distribution, or does a big Roth conversion in a single year, can accidentally trigger this surcharge 2 years later without ever connecting the dots. What most people don't know is that if the reason your income spiked was a one-time, life-changing event, like retirement itself, a divorce, the death of a spouse, or a work stoppage, you can actually appeal it. The form is called SSA 44, and it lets you ask Social Security to base your premium on your current lower income instead of the 2-year-old tax return. Number 6, and this is the one that's been quietly costing retirees money for over 40 years without a single adjustment: Social Security taxation thresholds. Here's something that genuinely surprises most people the first time they hear it. Up to 85% of your Social Security benefits can be subject to federal income tax, and the income thresholds that determine this haven't been adjusted for inflation since they were originally set, one back in 1984 and the other in 1993. For a single filer, if your combined income, which is your adjusted gross income plus non-taxable interest plus half your Social Security benefits, exceeds $25,000, a portion of your benefits becomes taxable. Cross $34,000, and up to 85% can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000. Because these numbers have never moved with inflation, more and more retirees get pulled into paying tax on their Social Security every single year, even modest earners who never expected it. Despite plenty of talk in 2025 about eliminating taxes on Social Security entirely, that did not happen. The One Big Beautiful Bill Act left the Social Security taxation formula completely untouched. What it did instead was create that new $6,000 senior bonus deduction we covered in Rule Number 1, which can indirectly reduce how much of your Social Security ends up taxable because it lowers your overall income. What most retirees do wrong is assume that because they heard something about a "no tax on Social Security" headline, they're now exempt. You are not, unless your income genuinely falls under those old thresholds. Strategies like the qualified charitable distribution from Rule Number 4 are one of the few legal ways left to manage your way under these lines. And one more before we wrap up the list, because this is brand new for 2026 specifically, and it's easy to miss if you don't itemize. Number 7, the new charitable deduction for people who take the standard deduction. Starting with the 2026 tax year, even if you don't itemize, you can now deduct up to $1,000 in cash donations to charity if you're single, or $2,000 if you're married filing jointly. For years, if you took the standard deduction, your charitable giving got you nothing on your tax return at all. This closes that gap, just modestly. It won't replace a qualified charitable distribution in size, but if you're not yet 70 and a half and can't use a QCD, or if you give smaller cash amounts throughout the year, this is a new, simple way to get at least some tax benefit for money you were already planning to give away. So here's your one concrete action step for this week. Pull out your most recent tax return, find your adjusted gross income, and compare it against two numbers, $75,000 or $150,000 for the new senior bonus deduction phase-out, and $109,000 or $218,000 for the Medicare IRMAA cliff. If you're anywhere close to either line, that's your sign to call your tax preparer or your IRA custodian before December 31st, not after. Because several of these strategies, especially the qualified charitable distribution, only count if the transfer happens by the end of the calendar year. None of this requires a financial advisor, a law degree, or hours of research. It just requires knowing the rules exist, and now you do. If this helped you spot even one deduction you didn't know about, subscribe because next week I'm breaking down exactly how Medicare open enrollment mistakes are costing retirees hundreds of dollars a year. And that one applies to almost everyone watching this.